connection to make sure that everything's working and we're good to go.
Sounds good.
Здесь просто небольшая задержка, мы просто можем начинать. I think there is some background noise from somebody. Okay, yeah, and we're late. All right, so hi everybody, thank you so much for joining us today at Value Tokenized for our panel discussion and debate about tokenized funds. We would like to thank our viewers and we would like to thank our participants who are here with us today. So today with us we have David Benizri, the CEO of Rivver, an Israel-based company for tokenization and administration of funds. We have Pavel Cherkashin, straight from San Francisco, from Mindrock, the NGVA capital. And finally, the last but not the least, we have Lambert Despaux from Scheme Investments, also based in Tel Aviv.
Hi, everyone.
So, maybe starting from David, can you tell us a couple of words about what you're working on right now before we go into the main part of our discussion?
Sure, absolutely. I would say thanks Masha or thanks Xenia, but I'm still not sure which is which. So thanks to both of you. So hi all, great to be here. My name is David Benizri. I am the co-founder and CEO of Rivver. Rivver is a platform for investment funds to issue securities digitally using blockchain technology and manage their fund administration processes.
Okay, and about Pavel, can you tell us a couple of words about yourself and what you're doing? What's your relation to tokenized funds?
Yes, I'm based in San Francisco. I run two investment companies. One is a traditional venture fund called GVA Capital. It's about 150 million under management, investing in AI, self-driving cars, and this kind of things. And Mindrock is focusing on alternative investments, including crypto and a little bit of cannabis recently. So I've been investing in the space, and I'm preparing to launch another fund, and I'm in the process of deciding if I want to tokenize it.
All right.
Oh, still the process. That's good.
And Lambert, can you tell us about yourself and what you're focused on right now?
Yeah, so thank you very much for having me, first of all. Scheme Investments is a micro VC specialized on distributed ledger technology, so everything that's around blockchain. We focus mainly on digital securities nowadays. Full disclosure, we have made an investment in David, which is here, and we're pretty much looking forward to grow in the sector.
All right. Yeah. Thank you so much for telling us about yourselves. And right now, getting into the topic, why they decided to hold this discussion. The topic of tokenization and tokenized funds especially has been around for around a year, maybe even more. And as for the benefits tokenization promises, it's first of all like potential liquidity, the transparency, the ease of fund administration. Some people claim that the benefits are not there yet. And I think starting maybe again from David, I would like to ask you, what are the actual benefits? So why one should tokenize the fund? Why your clients, David, why they should tokenize the fund and maybe use the services of tokenization company? What benefits it brings?
Yeah, sure. Great question. So first of all, to be full disclosure as well, like any kind of new innovation, especially in the capital market space, it always takes a couple of years before we see proper volume and a lot of the institutions taking the lead. So this is totally expected. But I think even though it takes time to see mass adoption, we are seeing a lot of positive strides in the industry, a lot of great issuers digitizing their securities. So it's best to focus on the long term, especially when it comes to funds. We have life cycles. We have, whatever it may be, 7, 2, and 2, 10, 2, and 2. We have a long time where we have a long time to think ahead of us. So it's important to think long term. So I'll start with the long term vision, the main benefits of tokenizing or digitizing on blockchain limited partnership interest, which in my opinion is very well with regards to secondary market liquidity. That's how the space started. That's how it got founded, and that's the future. And we have that liquidity. It stems from the fact that by putting all the information related to regulatory transfer restrictions, contractual limitations, and ownership data into a distributed ledger, what that enables is for these interests to trade frictionlessly without middlemen on a global level in a digitally executed way. So it's two things. You're able to eliminate a lot of intermediaries from the picture, like lawyers and transfer agents, and it's a much more efficient way to transfer. Currently, it's done via paper contracts, and then once those contracts have been signed, you have to manually update the Excel, which holds the list of all limited partners in the fund, which is usually held by the lawyer or transfer agent. So that whole process can take 6 to 8 weeks. It can cost investors tens of thousands of dollars, which obviously is very hindering to any kind of asset class. So we believe that by making it more efficient, you allow for these kind of assets to plug in the secondary marketplaces like eZero, like ArcChat, like Open Finance, which enable for these assets to trade globally in a much more fractionalized level. And like you've seen in any kind of financial security, when you make the transfer process more efficient, it will automatically increase the ease of trading. And when you increase the ease of trading, you increase the value of that asset. So that in itself is tremendous value. And from a fund manager's perspective, being able to provide liquidity for your LPs is currently priceless. And I say that because we see a lot of venture-backed companies are remaining privately held for historically long periods of time. The average time for an IPO 6 years ago, the average time for an IPO 15 years ago was 6 years. The average time for an IPO today is twice that, 12 years, which is causing fund managers to extend their terms, and as a result, a lot more liquidity for limited partners, which is why the secondary market today is worth $62 billion. So by being able to provide a more efficient way to tap into this market, it's just an obvious solution as to why do it digitally as opposed to do it with papers and middlemen.
All right, yeah, thank you so much, David, for this description. And but I would like to ask Pavel. So these benefits that you just described, they're really clear. It's really like this technology does have the potential to disrupt this market and really be able to cut the intermediaries and to not to waste like the 6 or even 12 years raising capital. But even though these benefits are clear, like Pavel here, he still hesitates. So it might be not so clear. So, or maybe there are some disadvantages that are preventing you from going for tokenization of your next fund. So Pavel, can you maybe comment on what David has just told us? Yeah, share your perspective.
Yes, thank you. First of all, I need to say I'm a big believer in tokenization going forward, long term, right? I love the idea of democratizing access. I feel really sorry to see that this asset class is only available to large investors, right? We were making more than 60% IRR over the last 3 years on our investments, right? And now most of our investments are high net worth individuals, and I would love to see more of normal people in this on this market. And I did several articles on this. I invested more than $50 million into blockchain related projects over the last 2 years. So I'm a big believer in the space overall. But now when it comes to actually doing a fund, I face several critical problems. The first problem is what is supposed to be the benefit with the liquidity actually turns it back on us just because because of the hype last year, most of the investors have this expectation of very quick returns. They make an investment in a venture fund. 10 minutes later, they're already complaining online about why their investments haven't doubled yet, right? And they would saying, oh, we can invest in another place, why do we have to invest here? So the market has to cool down so that people have realistic expectation. When I say 60% annual return, people will say, wow, but in crypto world, they say, okay, it's nothing special, right? So I'm waiting for this market to cool down. The second problem is with the technical access, or with the wides, with the broads of access. So if I bring $100 million fund onto any tokenization platforms, if I bring it to all of the tokenization platforms out there, they just don't have enough investors to fill even a significant portion of this. So it will probably take some time, I don't know, maybe a few months, maybe years, before there's enough of investors out there that are interested to participate in this project. That's the second problem I see now. And the third problem is more of a psychological thing, but it's the result of the first two, which is the double selection. So the products that you seek, basically the best products don't have to tokenize. The best products can raise money without doing this, because there's plenty of capital available on the market now. So this means, people start thinking that if you, because there are so many shitty projects being tokenized, investors start to think that if you are tokenizing, this means that you're a shitty project. Right?
Right?
Yeah, if you are so good, why do you have to tokenize? Why don't you do it a traditional way? Mm-hmm. So this means that we also have to make a lot of effort just to explain people that there's nothing bad about this, and this is not a quick speculative or pump and dump kind of tools, but it's a real market with the real potential. And unfortunately, I think it will take quite some time before we can really rely on tokenization of the funds as the primary instrument.
I think I will. Maybe we'll have to go for the questions first. I think we'll do questions
sorry,
after that.
Maybe I can bounce on what both David and Pavel said.
Yes, let's do that. And I also have a question to you, Lambert. So you're on the contrary. So Pavel's still hesitating. Yeah. But you are just about to launch the marketing campaign for the Tokenized fund that you are already launching. So my question is, why did you go for it? What is your outtake on the thesis that Pavel just mentioned?
Yeah, so it's both David and Pavel have very, very interesting points, and I like before bouncing on both their points, I'd like to take a step back and kind of repicture what we're talking about. We're talking about securities, which basically the modern form was born in the 1930s in the US and then spread around the world. And it's basically a piece of paper. This is today what a security is. So there's been innovation for everything that regards public securities. There have been exchanges that are now very modern and allow electronic transactions, but regarding private securities, we're still pretty much talking with lawyers and paper. Now, there's this tool that came around about 10 years ago, and which, like Pavel said, has had an incredible hype for the last few years, since basically the emergence of a credible platform for smart contracts, which was Ethereum. And it's kind of that the world kind of starting to realize the potential that this technology brings. And I think there's been a huge promise in 2018 with all the tokenization platforms kind of trying to get ahead of everyone else, but they were kind of asking the wrong questions. It's not because you're going to tokenize something that it's automatically going to have value. you need the asset that's backed by a security to have value. And the securitization in itself is only it's only a tool to allow for smarter transactions, basically. And David said that you had to look very, very long term, and I'm even going to go even further than David, maybe 20, 30, 40, 50 years, when potentially there's going to be minimum human interaction. And this is where blockchain really, to my sense, takes its full potential, is that it allows for automation of all the parts, the custodians, if any, the clearing houses, everything, the pots in themselves, everything is going to be automatized. And this is where, to me, it has the most value. So when we took the decision to kind of go to market and to tokenize our fund, it's not, we don't see an immediate value today, like Pavel said, but we need to be paving the way so that the technology gets adopted. We need to set the example, because if we don't do it, who does it? And today there's a lot of initiatives that are out on the market. David is a brilliant one, and we believe that together we're kind of setting the first stones to the next evolution of the system. So I don't think it's going to be a linear evolution. There's going to be lots of hurdles along the way, but this is what we're trying to clear them out the quickest as possible, so we can have kind of a good solution to come in the next few years.
Lambert, thank you very much. We have several questions from people watching, so I'm just going to start to read them loud. So one of the theses that often is heard related to tokenization of funds is that the way the VC industry functions right now is pretty much, if not outdated, but it's the same as it was 50 years ago, and a change is required. So the question we have from Boris Vikalov: our experience at SEO Box shows that funds are very interested in attracting investments from retail investors. Is it simplified with tokenization, and what are the challenges? So I remember Pavel said that there is just not enough retail investors that would like to and were able to fund this. And what are the other obstacles that we can face on this way?
Yeah, so my point is that first, there's not enough of them, and second, they have wrong expectations. They don't know how to deal with venture investments as an asset class.
Mm-hmm. Yeah, David, maybe you can also...
But I confirm that there's a lot of interest. I mean, I would love to have access to retail investors in a civilized way, and I think tokenization is the only way to do it. It's just a question of time.
Mm-hmm. And about
right. From my perspective, I think retail investors, there's a lot to be done there. There's a lot of interest from retail clients too, but in terms of our focus at Rivver and our clients' focus at Rivver, we at least focus on the high net worth individual, family office level, if not institutional level. That's just our focus right now. Perhaps we'll expand one day towards doing retail clients, but the way where we see the immediate value today, in terms of primary investors at least, is on larger checks, so institutions or large family offices, so that on secondary markets you can have smaller retail or accredited investors buy these assets on secondary markets, which is why we've seen platforms like Open Finance and Zero that have opened up trading to retail investors. So there's a lot of value when it comes down to secondary markets for retail investors, but for primary markets, we see the value more for institutions.
And Lambert, can you also comment on this question? Are you also focused on high net worth in individuals, or you would like tokenization to be one of the tools to access capital like from retail investors?
No, so my point of view of this is that I think that the regulator is simply not ready to allow this kind of of issuance to retail investors. When you think about it, digitized or not, you're still selling securities either to professional investors. We can debate a very long time on the definition of professional investor, but it is what it is. Or you want to sell it to retail investors who are unfortunately more in danger in regards to scams, etc. We're setting up a classic fund for institutional investors, and we think it would be too hard to try and set a retail fund with the state of the regulator today.
We'll go for.
I agree with that as well. That's a big hurdle.
Yeah. We'll go for one more question now, and then we'll continue to our discussion. And this is the question by Dave Hendricks. Hi, Dave. And the question goes, why does anyone expect a fund to magically increase by 60% or even 10% right after a fundraise? Just because the blockchain? I think it's a question for Pavel as well.
Yeah, I don't see a reason for that, but this is what's happening. I mean, you need to understand the whole venture business is built on building a barrier between an investor, who is called a limited partner, and the investments. That's why you have a general partner who is taking full control of the funds to make the investments. Because there's a psychological problem for a person to see the money being burned, and they prefer low risk investments. So when you put your money directly, you normally tend to avoid risk. And venture capital is all about taking risk. You make 10 investments, one of them grow 50 times, the other 9 suck and they fall apart, right? And in many cases, unless you can show stable returns from the portfolio overall, investors start complaining about that one that failed, not the one that succeeded. And they say, why would you need to invest in something that failed? Next time, don't do this, right? But this is not how venture capital works. So that's why most of the venture capitalists work with qualified institutional investors or high net worth individuals, because they understand how this market works. When it comes to retail market, retail investors in many cases, they chase some quick returns and they have certain expectations. And I think the global economy spent maybe 50 years from the 30s, or even 70 years from the 30s of the last century, to educate people on not expecting any magical returns. But then the blockchain economy came 2 years ago, and it showed that, oh, actually, you know what? You can make a lot of money by just pumping and dumping and trading, and suddenly all of those people became traders. And most of them have lost their money since then, but the expectation of high returns is still there. So that's why I said that there is this mismatch in expectations.
Yeah, right. And proceeding to the next topic, Lambert just mentioned that regulators perhaps are not there yet. And I would like to continue by asking, what is the current tokenization that enables tokenization of funds?
Next regulation.
Yeah, sorry. I think that it's a question first for Lambert. Maybe you can first tell us what regulation you are relying on, and then we'll move to a broader topic by asking, I think, the next question to David. So Lambert, can you tell us about your fund?
Yeah, so first a small caveat. I'm very far from being an expert on the subject, but we've been doing our homework, and so we're going to be setting up our fund in Luxembourg under a light regulation called RIAF. So I won't go into the technicals, but basically our offering is dedicated to professional investors. So that's in Europe, it's people who can invest, depends on the jurisdiction, but in excess of 100 or 150,000 euros. So we will be obviously restricted to marketing the fund to any retail investor. So there are today, I know that there are some regulations for SMEs to be able to issue, to raise, I think it's it depends on the country. In France, I know it's 8 million euros, and that is also to retail investors. But it has to be under certain conditions, and it's the process is a bit heavier, so we won't go with that. So it will be just the classic institutional investor kind of offering.
Mm-hmm. Right. And as for Luxembourg, I think this jurisdiction is one of the most advanced in terms of tokenization of securities. I think there was a bill
blockchain in general.
In general.
Yeah,
so is there any difference if the fund is tokenized?
I'm sorry, can you come again?
And is there any difference if you're setting up a tokenized fund? So is there anything you have to keep in mind during this process?
No, not at all. I mean, there's a law that passed in Luxembourg in February this year, which basically allows you to have a register of shareholders or register of investors on the blockchain. So that's a really good, basically because it kind of assesses the blockchain as a tool to do what we want, which is kind of track ownership of securities. So there's nothing in particular that you have to do because you tokenize your fund. Basically, what we're going to do is just going to create a fund as if it wasn't tokenized and just use the blockchain as a register of shares. And actually, not only that, but also with all the services and automatization of services that our blockchain-based software is going to allow us to do. So not only we're going to use it for regulation purpose, but we're also going to use it as a competitive advantage in terms of overhead or capacities of the solution we're going to be using, basically.
Yeah, I love the idea of using blockchain as the backbone just to do the administration. Like, if somebody would come up with a system like Carta, but on blockchain, that would, I would get in line to be a client for that.
Yeah, I think we have.
That's tokenization, right?
I think we have Dave Hendricks, who, by the way, just asked another question of Veritalo, a cap table management platform for tokenized securities. So maybe you should take a look at this. And by the way, I think here's the question. Yeah, one more question from Dave, as we brought him up. That's as a follow-up. Underlying asset values in a fund don't exit for years, especially when investing in early-stage companies. How many early-stage investments do you have to make to return 5x in 5-7 years?
Well, it depends. So I look at this from the following perspective. So it's still a lottery, right? Investing in early stage is like buying lottery tickets. But the qualification and the expertise of the managers just reduces the cost of the ticket. It gives you a discount. So everybody buys a ticket at $1. You buy a ticket at 1 cent, which is 100 times cheaper than everybody else. This gives you an advantage. But if you're not successful, you can make 1,000 investments and still miss. There's about 300,000 active startups early stage out there. Only 20 to 30 of them will turn into billion-dollar businesses. So this means that you can make 295,000 investments and still miss the ones that will make you profitable. Or you can make 10 investments and one of them or two will be successful. So the best investments, the most legendary investments in the world in early stage, they can hit the ratio of one successful startup per 20 investments. That's like the golden standard of the industry. I hope to answer the question.
It's a very great example, Pavel. I like that lottery ticket example. Very clever.
Yeah.
Thank you.
I think so. We just mentioned, using blockchain as for administration of fund. Basically, I think this pretty much goes in line with the question from Mr. Sell.
It's Paul Kahn.
Paul Kahn. Yes. The question is: are there any other benefits of tokenization, digitization outside the trading of assets? And I think this goes pretty well with the point of administration. So, David, maybe you can dive deeper in that. How does this instrument help in the administration and management of funds?
Sure. Yeah, absolutely. I think that's a very good timing to bring up this point, especially as Lambert and Pavel were speaking about using blockchain as a backbone to manage the registrar. So yeah, that's actually a huge part of what we're doing at Rivver, is that we're not simply a platform for funds to issue digital securities, but we are an end-to-end fund admin software as well. So we handle things like subscriptions, capital calls, portfolio management, distributions, investor reporting, etc. The main benefit of this is that every single action which is done on our platform is automatically logged into a distributed ledger. We use Hyperledger Fabric. And what that does is that it creates an audit trail which every stakeholder in this transaction, and only the stakeholders in the transaction, have access to. And everyone here can be sure that this data is never tampered with. So that includes the regulators and that includes the auditors. With the main benefit of this being that it will highly facilitate cost around audit, since the auditor knows that he can go to one place, access all information, and be fully confident that it is fully accurate and has not been tampered with. So that is the biggest benefit with regards to doing fund administration on blockchain. There are several others, like you can automate distributions, you make subscriptions a whole lot easier, and etc. But the main one, as we've seen in a lot of institutions adopt and a lot of major banks having a very keen interest on, is this audit facilitation tool.
Right, yeah, thank you. David, we'll take one more question from Jonathan Turnham. And the question goes, if you tokenize a share register, how do you verify investor qualification compliance requirements, monitor for sanctions, and undertake tax reporting, FATCA and CRS, or do you have a whitelist? I think, who would like to take this question?
Maybe I can give a first kind of first answer. Maybe David, if I'm omitting stuff, you can come back. But basically, so first of all, we're not digitizing, we're not tokenizing the share register. We're using a blockchain as a share register, and we're creating investor participation in funds. Everything that is mentioned in that question, investor qualification, compliance requirements, monitor for sanctions, etc., that's basically what smart contracts are for. This is the beauty of digitizing security thanks to blockchain, is that we have a programmable way to enforce regulation before any transaction has taken place. So it's kind of, I see digitization of securities kind of 50% as a reg set and 50% as made for liquidity.
Yeah, totally agree. Well said, Lambert. That's the whole point of tokenizing, especially ALP interest or any kind of security for that matter, is that all matters related to compliance, be it contractual or be it regulatory, is actually built into that security. Meaning that, for instance, if there's a 1-year regulatory lockup period, the issuer can be sure that the LP will never be able to sell his interest during that lockup period, which is very valuable, because if a certain investor breaks this kind of limitation, it's very harmful for the GP. It can cause a lot of problems in regards to tax and in regards to regulation. So by being able to be ensured that, this will be ensured in an automated way without lawyers is extremely valuable. And that's the main point of smart contracts.
I have the same expectations from the fund's perspective. So to put it in simple words, I would expect the platform that issues the token to make sure that nobody can buy this token or sell this token or do anything else with this token technically if it violates the rules of the LP interest. So let's say if you can only own this LP interest if you're a qualified investor, there needs to be an attribute in a wallet or in the smart contract that will just not allow you to transfer it to any wallet that is not associated with a qualified investor.
Right.
Yeah, absolutely. That's what we're here for.
Yeah.
Right.
And back to discussing regulation, I have a question for Pavel, because we saw kind of from Lambert's perspective how it happens in Europe and in Luxembourg especially. And what about tokenized funds in the US? Are there any specifics? And what you should keep in mind, or anyone should keep in mind, if you're launching a tokenized fund? Is there anything different from doing it the traditional way in the US?
So the good news is that most of the required regulation is already in place. So there's no need to change anything from the legal standpoint. The bad news is that first, this whole regulation was very anti-retail investors, with the idea to protect those retail investors, but in reality, this limits the ability of retail investors to participate. So now, I, for example, have to deal only with qualified investors. And anything related to retail investors would require going to a special certified and licensed platform that are allowed to do it. But those platforms are already in place. I would say the biggest technical limitation in US now is related to the fact that banks hate this market. Banks think that this market probably is a big threat, or I don't know what, but there's a big bias against anything crypto. Even if you're not related with trading bitcoins or speculating, still. So I lost all of my accounts, including my funds account, in a bank that I worked with for 10 years when they learned that I was investing in crypto projects, even though I didn't touch bitcoins. So I had to become very careful, and to open a bank account in a crypto-friendly bank like Silvergate, you need to wait in line for like 6 months just to get your application approved. I see that as one of the biggest technical limitations. We still live in the world where we have to get and send money through traditional banking systems, so we have to rely on those banks heavily. But in terms of the technical regulations, the existing regulations with Reg D and Reg A and Reg S are perfectly suited for tokenization. So I wouldn't be worried about that much. And I think U.S. regulation is very advanced and very far ahead comparing to many other markets, but it's just very strict when it comes to one single thing of dealing with retail investors. And there's also I need to confess one thing. What we do in venture business is mostly insiders trading. We find insight from a company and we make our bet based on this insight. If you do the same on a public market with retail investors, that's like 20 years in prison without any chance out. On the private venture market, it's considered a common good practice. So when tokenization is bringing those two worlds very close to each other, it becomes very risky on, making sure you don't, one small step on the other side will get you into a lot of trouble.
Yeah.
I think that's also the reasons why the market is keeping very close and protecting itself from the flow of retail investors into it.
Yeah, if I can just interject here, Pavel, if you don't mind, regarding your comment on banks. So I definitely agree with you that banks were very skeptical of DLT as a whole with regards to 1 year ago. But now I can say with full confidence that this is no longer the reality. If it comes down to securities applications that are doing it the correct manner. And just FYI, I have invited a few bankers from top banks that I know are tuned in right now. So if you're hearing this, hello, I hope you're enjoying. So with regards to the banks, it's just about if you do it properly. If you're doing everything right and you check all their boxes, they are very open and very keen, I would even say, on DLT applications. And by doing it correctly, what I mean by that is very much around the topic of what kind of blockchain are you using. They don't want to hear anything related to Bitcoin, and they don't want to hear anything related to Ethereum. If you do it on a proper private permission-based blockchain like Hyperledger Fabric or Corda, they are very receptive, and they have pilots on it themselves where they've already processed billions of dollars. Like, for instance, us at Rivver, we are grateful to be a part of the IBM Accelerator, the IBM AlphaZone Accelerator. And IBM, through them, they have a network of banks that are using DLT today. It's a lot more than anyone would think. And a lot of them haven't gone public with it, but they are devoting really significant resources towards developing a solution on this technology. So I think that it's important that before we automatically label every bank as anti-DLT, that we acknowledge the fact that there's a lot of things going on behind the scenes which we don't necessarily see appear on CoinDesk.com.
Look, I disagree. I mean, when you go to a conference, you see all of those bankers speaking about the future of DLT. When I go to my account manager at Silicon Valley Bank, First Republic Bank, by the way, those two banks cover like 80% of all of the venture capital in Silicon Valley. Bank of America, Merrill Lynch, which is pretty much the same, Morgan Stanley. I came with a very simple and straightforward question to my account manager, where I already have accounts for my entities. I had a very simple question: will you open me bank account for the tokenized fund? It's going to be fully regulated, all compliant. Nothing, no gray area. All will go through your compliance. None of them said that they will open the bank account. All of them actually said, no, we're not going to be able to open a bank account. And when I said, why, what's wrong with this? They said, we just don't understand it. It's too much of a gray zone for us. Sorry, we can't do it yet. So that's what I'm talking about, right? So I still need a bank that will say, yes, you will have a bank account for this. And I can go to Silvergate and maybe Signature Bank. Those are crypto friendly, but those are, those are not my banks. I want my big banks to be able to work with me.
Right. Yeah. So on that level, I definitely agree that it's not necessarily that as a general philosophy that they're against tokenized funds if done correctly. Just the fact that they don't understand it correctly up to the account manager level, as you're mentioning. So for that reason, especially given the fact that the market for tokenized funds is still in very early stages, it's just not worth it for them to take this risk. So, but I think it's important to split up with regards to opening, small accounts versus these banks internalizing technology and using it for their own processes, which should be split into two categories. Because oftentimes they're mixed, and I think that hurts the whole industry as a whole for everyone to have this preconceived notion.
And speaking about that, I would also like to ask Lambert if he faced any of the similar challenges in his region and in his experience with the banks. What are your position on this, Lambert?
So we established our first fund in Malta after they came out with the big plans of kind of establishing a legal framework for for blockchain in March last year, and all I can say is that it's been very, very disappointing so far, and we've been fighting against banks to get accounts opened. So yes, this is currently a very true challenge, but it's changing. I haven't yet been on the ground talking to banks in Luxembourg, but I know that there've been works with banks that are already considering opening accounts there. So I can't tell you for sure for Luxembourg, but if the fund is established in Luxembourg and recognized by the equivalent of the SEC, what I hear is that there shouldn't be major problems to open bank accounts there. And just to bounce really quick, I think David had the right conclusion, saying that all those banks are. I know for a fact as well that they're investing and they're kind of creating platforms to kind of integrate those technologies. But that's very different from opening accounts, opening business accounts, which from a risk perspective causes much bigger problems. And someone could think that they kind of have the handbrake on this until they are able to develop themselves the technologies so that they can control the markets a bit better. If I have to kind of be a devil's advocate. But and then one last thing that Pavel underlined that's really, really true is that we're really blurring the lines between private and public with tokenization. If we achieve the high level of liquidity that we're promising, we're kind of outdating the public funds. So it's going to be, I think there's going to be new regulation to be put in place, and I think the markets will evolve to kind of accommodate what's the old school publicly listed funds and the private tokenized, because we're kind of achieving the same purpose.
Yeah, I found that point about kind of the border between venture capital and retail investments kind of disappearing, which is very interesting to think about from, I think, maybe a philosophical perspective. Also, I think when it comes to banks, we just got the news, I think today or yesterday, that the first IPO in the United States, INX, yeah, using security tokens, basically, was just approved. So maybe this will drive more interest and more understanding from banks. But now I'd like to jump back to first things that we started with. We have another question from Dave about the liquidity. So it's one of the. It's not liquidity; it's about liquidation. It goes back to the thing that we were discussing before. Yes, that's exactly. So why would an investor in the fund want to liquidate early before the underlying company's investments have had an exit? I think that's a question for Pavel.
I'm sorry, I didn't understand what was the question about liquidation.
Yeah, so why would an investor in a fund want to liquidate early before the underlying companies have had an exit?
Okay, yes. So I'll explain this in simple words. What happens normally? The standard life cycle for a venture fund is 7 years, meaning that when you invest into the fund, you commit to staying with it for 7 years. Now, and a lot of people get excited about this. They see how they're doing well. They want to put 10% of their wealth into venture capital. Now, a lot of things can happen in 7 years, right? The market may turn around. The business may go down. You may see a much better opportunity, and you need liquidity to put money into something else. Or investors can just get disappointed about the level of returns they're getting. Because in many cases, if you look at the financial statements of the venture fund, let's say it's a $10 million venture fund, right? The first month you show your net assets of $10 million. Then you invest $1 million, and you normally would value it at zero at that moment or maximum at cost. So the net asset value of your fund will go down until there is a certain material event. And it may happen that, on paper, your value is going from 10 million to, let's say, 500,000 in 5 years. And investors can get upset or even crazy about this, and they want to sell. So there's a negative motivation for a sale. There could be a positive motivation of a sale if they just see a better opportunity on how to do money, or if they just need liquidity, I don't know, to buy their house. So it just because 7 years is a lot of time and a lot of things can happen in this period. We as managers, we want to give this option, this opportunity back to investors, because if we can, instead of saying no, your money has to stay with us for 7 years, if we can tell them, look, at any moment of time, even at a loss, but you can still go out and sell your LP interest in our fund, that's a great selling point, and we can attract potentially more investors.
And jumping to the next question that we have, it goes from Konstantin Kuprianov. It says, "Hi, I'm Konstantin, marketer from STO Box. My question is, how do you solve the problem for secondary trading of assets? What is the best way to provide liquidity to a security token?" And I think it's perfectly aligned with what you have just said, that it would be a great selling point if someone could exit from their LP interest. Maybe you also can take this one.
I think it's more for David about how you technically do this, right? If I understood correctly, the question was more about the technicality of how you do this.
I think probably it would be best for David. So how would you do that from a technical perspective? And also, where would you actually see this assets trading? And I would also add one more question for myself, like who would actually buy these assets on secondary market?
Yeah, sure. So great question. So as I was mentioning in my introduction, with regards to the technicality of it, first of all, which then leads towards the market expanding, is that the transfer process is now going to be automated with regards to two things: with regards to regulatory compliance and with regards to the trade execution. So currently, things like who owns the asset, can the asset legally trade, when can it trade, which kind of purchaser is legally able to buy it at any given time, and many, many other terms that have to be verified manually by a lawyer. And then once there's an agreement, it has to be reconciled manually. There's papers involved, and it's a very large headache. So when you make this whole transfer process more efficient, more optimized, you're able to make it a lot easier to trade. And then when you make it easier to trade, naturally we see volume when you see this kind of innovation. Meaning if it took you 6 to 8 weeks to sell your Amazon stock, you wouldn't be selling your Amazon stock long. That's the reality. So by making it easier to trade, you're able to open up the market a whole lot more. And when you do that, you're able to open it up globally to a much wider range of investors, which touches on the next question. So currently, when dealing with LP interests, they're usually limited to very, very large secondary funds like Kohler Capital, which because they're so large, because they're going to purchase your whole entire stake, they're going to give you a penny on the dollar, a very discounted price on that interest. Whereas if you're securitizing it and you're splitting it up into chunks, still for professional investors, right, not for retail investors, even for large family offices or smaller secondary funds, you're able to increase the demand for it, and as a result, increase the price, which is a very big benefit for limited partners. And where is it going to trade? It's my opinion, it's going to be mainly done through brokers and ATS platforms. So alternative trading systems in the US, companies like T0, Open Finance. In the UK, you have a company which we're excited to integrate with, Archax, and it's going to happen mainly there. So it's not going to be like the stock market. You're not going to have buy and sell orders in a matter of split seconds, but it's going to be a whole lot more than what we're seeing now.
Right. I think we'll take one more question, or it's like more a comment from Sustaining Capital before we call it a day. So this question goes that the state of blockchain protocols right now is far away from enabling complex tokens. Security tokens are at best several years away, and current platforms still have a problem while introducing two new. And actually, I would like to Lambert first to answer this question about your approach to security token protocols. So why, for example, what helped you make your decision for the tech provider, and what maybe there were other solutions, for example, other than working with Rivver? And what made you choose exactly this provider? And how would you answer that there are more problems created than solved?
So the answer is very straightforward. Is because we invested in our project. It kind of no, but the way it went is that I kind of agree with that comment. Generally, is that the state of the market today, there, in our opinion, there is no solution. There is no platform that can do everything that security token promise from A to B. There are a lot of notable hurdles to kind of check all the boxes, all the promises of security tokens today, and I won't go into them because they very quickly they become very technical and kind of ending on our conversation here. So, but what I can say is that there's a lot of very, very smart people kind of working into making those protocols more efficient, making them more secure, more compliant with the regulation. And when we thought, when we first started, when we rubbing our heads around our investment thesis and digital securities in general, we thought that it's easier to start with what you know best, and what we know best is actually investment funds. And at Scheme Investments, we don't really believe that in the future, there's going to be one size fits all. Digitizing an investment fund is very, very, very different from digitizing wheat or from digitizing debt. So when we met the guys at Rivver, we felt that it was actually a solution that we were very comfortable with, and we think that there is value for a lot of reasons that we've discussed tonight into digitizing an investment fund. And I think there is demand for the digitization of investor participation. So we kind of we found in Rivver kind of the niche player that we were looking for, and we want our administration and our insurance to be done very well by experts. So this was what motivated our selection and our investment, of course.
Thank you very much, Lambert.
May I add very quickly that from what I've seen, technology is difficult, but technology always follows the market. So when the need is there will be thousands of people around the world, and they will figure out a way to bring the technology to the required scale. So it's not a question of 5 years. I think it's a question of a year after we see how this should work from the market perspective.
I agree with that. Very good point.
Yeah, I think our 1 hour is almost over. Yeah, maybe there is some final words that somebody would like to share. Maybe like a final point, like why should you tokenize your fund, or why you shouldn't tokenize your fund.
I'll add one very quick thing, and when I first spoke with Xenia, a couple of months back when we spoke about the idea of this panel, and we spoke about something specific towards tokenizing fund, and that I think is really great for the industry. And there should be more of a split between what kind of security we're dealing with. So I think it's important to take away that just because you might like tokenizing real estate or you might like tokenizing employee options doesn't mean that you should put it in the same box as funds. So I think for better or for worse, that's an important distinction to make.
And let me add that I look at this not only in terms of the benefits that we were discussing here, the practical benefits. For me, the ability to tokenize the fund is the ability to challenge the status quo on this market. When you have less than 1,000 40-year-old white men like myself making decisions for 7 billion people around the world, which is completely wrong, right? We want more diversity in this business. We want more people involved. We want more smaller funds. And the only way to do this is through tokenization. So I'm really looking forward for this to happen because this will change the whole industry, the way we know it.
Right. And Lambert, would you like to say a couple of final words for today?
Yeah, I agree with both David and Pavel have said, and I think everyone has to realize that even if for industry observers it seems like something that's really very old, but I think for the state of the technology we're really very, very, very early, and it has the potential to disrupt the capital markets as we know them. It has the potential to foster more inclusion, and I think it has the potential to make the capital markets evolve towards its more natural and future state. And I think it's important that a lot of actors keep on working very hard and making that happen, because the potential benefit for finance and at large society is major. So it's important to keep the grind going.
Right. Okay, thank you very much, everybody. Thank you, David. Thank you, Pavel. Thank you, Lambert. And also thank you to everybody who was watching and asking really interesting questions. So I think if somebody else has any questions to the speakers, I'm pretty sure, and correct me if I'm wrong, but that they will be happy to answer and continue this discussion, not live. So, and yes, thank you very much again for being with us at Value Tokenized.
Thank you very much. Thank you very much.
Thank you.
Good night. Thank you very much.
Thank you. Have a great day and evening. Thank you.